Your pension savings are invested in different types of investments, like shares in companies, what we call equities, bonds, or property. Investments are traded on financial markets, and how they perform will have an impact on the growth of your pension savings. So it's important to keep abreast of how financial markets are faring and the outlook for world economies. Sometimes markets face periods of volatility or sudden and unexpected changes that can affect how they perform in the short term. Recent years have seen lots of uncertainty, and while we expect the outlook to be more stable this year, we've already seen that there could be bumps along the way. The positive news is that Europe seems to have avoided an energy crisis for now, and governments have shown that they will act quickly to limit the effect of any volatility. China has ended its COVID lockdown policy, and emerging markets may offer opportunities for some better investment returns. In the UK, the Bank of England has said that any recession will be shorter than it originally thought, although we do seem to be in a period of slower growth. The bank also hinted that with inflation or rising prices showing signs of falling, interest rates may not have to rise as much. Overall, the global picture is that many economies are expected to grow more slowly or not at all in 2023, and markets will be paying close attention. While there are undoubtedly challenges for the markets in the short term, we remain confident in the outlook for returns over the longer term. In the final 3 months of 2022, the UK stock market performed better than expected, with the index of shares in the top 100 largest companies getting close to an all-time high. That could point to a shorter period of slower growth and a better outlook. In Europe, markets reacted positively to better news on inflation and falls in oil and gas prices. Asian equities were also strong in the final 3 months of 2022, with China likely to push for economic growth. Despite strong recent performance, there are some concerns though that high inflation might be harder to shift in the US. This is because employment levels are so high. It could mean interest rates might have to stay higher for longer. Turning to bonds, we believe that yields, the interest rate paid by bonds, have begun to look more attractive than they have done for several years. What's more, if inflation eases and economic growth slows, bonds may recover some of the losses they made last year. When it comes to property, areas that are protected from inflation or that have a focus on energy efficiency or affordability are expected to perform better. So, overall, we can see how different types of investments are affected by the economic and by market changes. This shows how important it is to have a spread of investments. In other words, not having all your eggs in one basket. Most pension savers are invested across a range of different types of investments and geographical regions. That means risks are spread out and can help ride out bumps in the road. To sum up, better news from the markets at the end of 2022 means that we're cautiously optimistic as we look to the year ahead.